Hmm. Hey guys, we're gonna go ahead and review the S&P 500 futures. Today we do have the interest rate decisions for the Fed. Well, right now we're gonna go ahead and review the higher time frame. All right, so it looks like we're rejected from this level. So this level seems to be the one that is rejecting now. Over here. It rejected on the and it's rejecting on the pre-market pretty much. Like every time that it comes here, it rejects. And I guess this level is from the here to here. That's too big. Yeah, that will be the level right there. It will be from the 6802s to the 6813s. That'll be a level to watch out for. If we get back to that level, okay. But again, this one is the one that it still holds the most because look, like it's been rejecting like multiple times, and plus we still do have that low volume node right here. I'm not sure if it's still relevant, but again, today we're looking pretty bearish. BWAP, we're opening below BWAP right now, and we're going closer to this level right here, which is the 6700. So we go to a 30-minute time frame and we start looking at this. We rejected from this level again, and we're opening below BWAP price. So if anything during the open, we might encounter this LBN, which if we look at it, it was from yesterday's pre-market. It bounced from it and then whoop, it went really fast through it. So got a bit of reaction for it, but if we're truly bearish, I'm gonna be looking to fade it right here on this supply level right here, which is the 67, 69 to the 77s, and BWAP is right there. So if we get to there, I'll be looking to fade it for a move towards the downside. And that will be the plan for the pre-market. Now, if we come above it, then I'll wait for the retest, and then I'll be targeting right here the 6793s to the 6797s. I'll probably, like, depending on what happens at the moment, maybe there is some absorption. We see some bullish absorption, or we see a bounce off of the BWAP. All right, because we already got a bounce off of BWAP right here on the pre-market, but it was towards the downside. So maybe we're gonna get it again this time right here. All right, economic calendar, pretty simple. We have the interest rate decisions like pretty much for everything, and then if we look at the volume session right now, this is from yesterday. There's literally no volume right here, like literally, like no volume right here. Like, yeah, the volume is been really thin. It's really thin volume. It seems like this pre-market is where we've been having the most volume, but other than that, it doesn't seem like it is really doing anything. Right? So we have 3 minutes until market opens. Let me see. Do I have my drawings over here? Okay, I need to update some of these drawings right here. So this one is where BWAP is, and I don't have this level, which is the 6752. 25 to the 4150. And so let's review. Do our pre-market analysis. Key levels. Yeah. We did economic data. We checked it. Yeah. Volume profile. Yes. We did check it. LVNs. Yes. That's a setup discipline. So ooh, we're getting some bullish momentum. Oh my goodness. Okay, guys, market just opened over here. Okay, so we're approaching that low volume now right there. And it is rejecting from it. It is rejecting from that low volume now right there at the 6785. I mean 88. No, no. 6758. It is rejecting off of it. Let's see if we can see some sort of I mean, like I said, like if anything, I'll be waiting to see what happens at the BWAP, which is 6768. That's what I will be mostly looking for. That's what I'll be looking to do. I mean, look at that. It's just a huge rejection of the low volume node. Okay, so now that we see that we have some selling on that low volume node, what I would like to see is a pullback and just fade it. Sheesh. Yeah, LVNs. And that was my mistake yesterday. I was trying to long off of a bearish LBN like this. Let's say, for example, price is underneath the LBN. And then I was trying to long it like from there because it just looked like this. It looked bullish as fuck. Yeah. Man, this thing is just mm, fucking boring, bro. Yeah, I want to see if we can take those 42s. Or when everybody says like this shit is ass. They're pre-market lows, right? So what happens whenever we reach back out to these levels is from the 32s to the 36s. Hmm. Oh. I want to see it completely take out the 32s because they will reappear right there on the 32s. Hattest du? ¡Ey! El gordo. Mucho, mucho. Come here, come here. Ay, ching. Mira, 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 mira. Mira, 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 mira. Mm. Honestly, don't like I don't see my edge. Like this thing is just like chopping around. I guess like the one that I could have done was like this one right here. But fuck, man. Good shit. Honestly, I would love to take the market short, like right around here at the 67.27s, like around here. Hola, mi gordita. Miau. ¿Qué pasó? ¿Qué pasó? Chu, 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 chu. I'm sorry, dame fuerzas, mami. I've played that as a failed breakout. Right, Orion? Right? So I saw what I needed to see. I saw what I needed to see. Come on. I enter at 67.37. 67.30 is 6.75. Yeah, right here. Come on. Come on, baby. What happened? This fucking internet, bruh. Oh my gosh. So break even, right? Okay, I think this TP hit. Come on. Yeah, I'm closing this position right here. Alright. Bro, bro. What? Bro, like this fucking internet, like, bro, seriously. It was a good trade though. That's a sell right there. It just adds more noise. That's the only thing that it does. This is the love day right here. ¿Estás acostado ahí? Gordo.
Hey, 2000K? How much are you gonna make? How much are you gonna make today? How much are you gonna make today? How much money are you gonna make today as a trader? Be honest, I don't know. How much are you gonna make today? 2000K? How much are you gonna make today? I got this. Pues de esto tiene indicadores con varios el vivo, price action, RSI, los bitrate, volumen probado, acumulativo del delta, ACI, EMA, UPA, y el PUSPE. Paid $90,500 for the month of June. Let's break it down. For my hospital job, I made $5,880. I got one more paycheck than usual on this. For my business, when I work food care, I made $4,585, which is more than what I expected for this month. And for our side hustle, which is let's say we made $500. We made one right? Okay, so one of those are right. We're gonna. Right. I don't get it. Then Carter, you're joking. What this one gets? 3, 2, 1, go. You have none right. Okay. Absolutely none. You've got none right. You just don't. Oh, one right? Okay. So one of those are right. So we're gonna.
It's I'll be back whenever FOMC. The same. It's the same shit. ¿Aló? Sí, aquí lo estoy poniendo. Ah, le faltaba una parte, no, no se la puedo encontrar. Ah, no sé, creo que es una de las tapitas, como una de las tapitas creo que es lo que hace falta. Mm, ya, oiga, una pregunta, ¿este humidificador bota agua? Sí, no, no, nomás pregunto porque a lo mejor fue que lo rellené mucho de agua. No, o sea, ya aprendió, pero me hace que está botando agua por algún lado, no sé, no estoy seguro. Pues lo dejé a menos del máximo. Bueno, mami, si ahí no quiero. Sí, no, es que yo creo que le eché mucha agua y se riega por los lados cuando lo muevo. ¿Ah, sí? No, pero está bien, mami. Ah, está bien. Ok. Okidoki. Bueno, mami, gracias. Bueno, chao.
Se está sumando también Lewis Ball en ese carrilisco. Uno, dos. Dos. Genuinamente.
Las mejores jugadas y de los grandes
Intelligence.
on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year, and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net, we didn't make progress. And if you look at total inflation, total core inflation, it's about 3%. And some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind. And the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut from most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so, there are 19 people, and so 19 reasons, 19 individual submissions. But if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation, not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year, progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you, Howard Schneider. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be core as well. Yes. But no, there's also just the feeling that we haven't seen, the progress that we'd hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy.
I didn't get the second part of it.
Well, the consumer is going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure your position in case growth starts to slow?
So, and the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. That's, to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption, that'll weigh on disposable personal income, and it'll weigh on consumption. But if that's going to happen, it's something quite different than that. We might have much lower than expected pass through. So people write down that, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just, you got to write something down. And this is something that is, that people wrote down. And so, we don't debate how do you do that? We wouldn't be able to debate what the length or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid. And inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, unemployment rate, of course, is little changed since September. A very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing, pretty well. It's just we don't know what the effects of this will be, and really no one does.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increase to domestic production. You can talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is, there is, the original thinking, the long-standing thing, you put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was
what the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rate rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment, and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target, and looking through the oil price shock, will undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully. But of course, that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. it's more the thought that it's been 5 years and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that. And we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick,
Nick Tamaros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say that the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent. To the extent those prices the tariffs are paid by consumers, on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for tariffs, which were put in place over the course of middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. It used to be, for many, many years, it was negative. And then, in the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So it's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates. We're not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks. And we feel like where we are now is just kind of on that borderline, the higher borderline of restrictive versus not restrictive. And we feel like that's the right place to be.
Can I ask a question on housing services though? Because there's some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
It's a good question. It's frustrating. Labor, non-housing services have basically moved sideways for a year. They're at the same level. We do expect that they will come down, but it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year rather, it's continued progress on housing services. Finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Thanks, Chevelle. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is supposed to be 3%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration generation policy largely. A ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can, we're at 3.0% core, inflation 2.8% headline. So we've been well above 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And what happens if there's no Federal Reserve Chairman confirmed on May 15th?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and that's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't receive more of you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there. And I'm not going to have any more to set on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to the tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report, that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply side story, has changed, despite the quite negative number in February. Would that be the right take? And was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to realize, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see? You take a step back overall. There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just a very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting effectively there's job creation in the private sector. But actually, that looks like that's about what the economy needs in terms of dealing with very, very low and non-existent really growth in the labor force, which we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balanced, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, if you look at that, we see it, we get it, and everybody understands the arithmetic, and that's you can say the break even is zero. But nonetheless, it's something we're watching carefully. And so, and we're concerned about, but ultimately though, you can argue that it's the consequence of deliberate policy, which is really the changes to immigration, because that's the biggest factor there. And, but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, two oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and they need to take something into account supply shocks as a more common problem?
You know, we did go through a long period where shocks were all the known shocks. So we've had a lot of practice and we've had a lot of supply shocks in the last 4 or 5 years for sure. It's just a very different thing, a very much more difficult thing because it does immediately where it's a question of tension between the two parts of our environment. So, it has the world changed. I mean, COVID is a one-time thing, right? Because the energy central offshore is a one-time thing. It's not because there's a lot of tendency to run again. And so, the big oil shock with Ukraine was also the consequence of military action. So I remember that the world has changed in a way that don't have supply shocks. But there were people have written that paper in that speech a number of times. I remember people tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in any of this before.
You said last year that the Fed was reviewing its communication strategies and including the SED as part of its framework.